Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it is now January the 6th, 2019. Trust all of our clients and friends had a wonderful Christmas vacation, holiday season, and also a happy new year to all of you. Well, we've started off the new year similar in terms of the markets as we ended the year with a lot of ups and downs and volatility. So I wanted to just recap quickly 2018 and make a couple of preliminary comments in regards to 2019. So on the slide in front of you, you'll see our disclaimer, our legal disclaimer, and again, just exhort you to read that, pause and read that in detail, and that'll keep our regulators happy. And it's important to note some of the things in that disclaimer. Now on slide 1 of our presentation, I just highlight 4 areas that we're going to zero in on. Number 1, just current market update, just a little bit about the volatility and what happened last year. Our Rocklinc performance overall for 2018, areas of opportunity, and how important it is to stay focused and looking for great investments and remain invested in great companies, providing, of course, that they're trading at good prices and have favorable futures. Okay, so on this slide number 2, you can see there a little bit what happened last year. And what we've done here is just gone through some of the major market indexes, and also on the next slide, which we'll get to in a few moments, some of the commodities and the change in price. Now you can see that the Dow Jones was actually down a little over 6% last year. The NASDAQ 5%, 5.3%, you can see on the chart there. And the S&P 500 about 7%. This is not incorporating dividends reinvested, just looking at the index numbers. The Toronto market, that's the S&P TSX, was actually down over 12%. In fact, as I pointed out before, the Toronto market, where it's trading now, it actually was higher 10 years ago, 11 years ago, back in 2007 and 8. The Russell 2000, which is a index of smaller capitalization companies, so not the big behemoths that you find in the S&P 500. Smaller companies was down 13%. The Nikkei, which is the Japanese market, was down almost 15%. The broader European markets, so this would cut across a number of the European countries, including France and Italy and Germany and so on, was down about 13.5%. The FTSE, which is the UK market in London, England, was down a little over 12%. And then on the next slide, we'll look at just a couple of the commodities. Gold was actually only down about 1% and change. And in fact, in Canadian dollars, this would just be in US dollars. In Canadian dollars, gold was probably up about 6%. Silver was down 8% in US dollar terms. Crude oil was down almost 25%. It was pummeled last year. And this is from the beginning of the year. If you actually remember, oil got close to $80 in the first quarter or two of 2018, which means that the drop from its high in 2018 was even worse. It was just a brutal year for oil. And then copper, I put copper in here because it's a good indication of economic development. Whenever copper is weak, it typically is telling you that the economies are weak, because copper is something that gets embedded in almost every type of construction and cars and manufacturing processes. And so it's a good indicator, proxy, if you will. It will correlate well with economic growth. You can see that copper was down almost 20% last year. So the summary of those 2 slides is it was a brutal year, and there wasn't too many places to hide last year in terms of the overall capital markets. And so even bonds were down a little bit over the full course of the year, over the full year, because interest rates over the 2018 from beginning to end were up, and that means prices of bonds dropped, although interest rates did jump up, and then they did come back a little bit in the last quarter of 2018. Now on the next slide, we just talked a little bit about Rocklinc portfolios. Now this is across all of our private clients. It doesn't include a couple of large institutional accounts. We run some money for a couple of institutions, but this is our private client accounts. In terms of our institutions, they're run slightly different mandates, and in both cases were slightly positive last year because of the conservative nature of those portfolios. But in terms of our Rocklinc private clients, we were down after fees about 0.6% on average. There'd be some clients that were with us at the very beginning of the year that might be down 2%. And then there'd be a few clients that might be just slightly positive. Again, that's going to depend on the mandate, how much equities we had, how much U.S. securities we had. If we had more U.S. securities, they performed better. So there was less, more upside and so forth. So there's going to be variance across our clients. I really caution you in terms of that. But the overall was 0.6% after fees and 0.4% before fees because our average cost is about 1%. So you can see then that, that's not too bad. I mean, we never want to be down at all. I hate being down. I hate leaving any money on the table. But relative to the indexes and what happened last year, I think we did quite well, particularly given the conservative nature of our portfolios. The Canadian equities, they were down about 8.7%, I should say, and that's about 36% of our book. And then U.S. equities about 31.6%. Again, this is it's an average across our clients, was up about 9.4%. About 7% of that would have been currency. So we would have been up a couple of percent even when you adjust for currency on our U.S. securities. And then money market was up about 2%. That includes bonds and so on. We're very conservative, and we've been making pretty good money on the bonds relative to the pathetic interest rates. So overall, not a bad year. We had a number of families come in at the end of the year. We had about 7 or 8 new families just in November and early December. And those clients, we only have about, you're about 30% invested, 35% invested. So the shellacking of the market did not have much impact on them. You might be down 2% or something, but that's only because you came in at the end of the year. But we're very careful. We haven't jumped into the market in any major way. We're going in slow, picking off opportunities as we go. Okay, so not too bad. Now, the next slide number 5. What's driving the market? This is similar to a slide we had in a previous update, so let me just point these things out to you. Concerns over slowing economic growth. You hear that all over the world. Apart from the United States, there really isn't a lot of growth in the world. And so that's going to have an impact on stocks. High debt levels, which we've talked about before. This number 3, and I'm going to talk about this in our year-end update in more detail and give you some facts and numbers behind this. But the impact of higher interest rates and less money printing. So we are going through a phase right now that is reversing all the easy money policies of the last 7 and 8 years. And as we tighten up money supply, pull money out of the system, increase interest rates, this is going to create a difficult equity market environment. And so it shouldn't surprise us that it's going to be tough slugging in the markets. And I'll have more to say about that in our update. Trade frictions, which you're hearing about, especially with China, as Trump and the U.S. try to balance out trade. Trade has been really one-sided, especially for China and India and countries like that. There has not been free trade, but the problem is that our whole system has become used to this, and so trying to straighten that out is going to cause volatility. There's no question about it. The Chinese are not going to just roll over and change things without a bit of a fight and without some back and forth, and so expect volatility. High valuations in the stock market. It's not cheap, so we have to be careful. Political unrest around the world. We see this, aside from trade frictions, you see this in Europe. Europe has got a number of countries that are in serious condition, the worst of which would be France right now, where there's just been uprisings going on for a number of months. A lot of problems there. And then lopsided headlines. I mean, be careful what you're listening to. The news media outlets, to a large degree, as I've already stated previous updates, they're just selling page views. They're not selling truth. And so one has to be very careful what you're listening to. On the next slide, Areas of opportunity, we've talked about this. Our companies continue to perform well. Cash is very valuable, so we use that to dollar cost average also to mitigate volatility. Precious metals, the last quarter of the year, our precious metals companies were up about 25%. So they're playing the role that they should play. That is, when the market goes down, they should go up, and they act as a ballast in our portfolios, which is great. And the companies we own have good growth prospects aside from commodity price appreciation in gold and silver. They'll still do well. Large dividend paying stocks are cheap, a lot cheaper. We're looking to those. Dollar cost average, some of our favorite companies, and then we are talking, Andrew, Jesse, and I are talking to a lot of companies. We're researching. We have a couple of companies right now that we're zeroing in on. And so we are not stopping in terms of the aggressiveness of our research. And then the last slide, slide 7, I just want to encourage you, look, we have to stay focused. Negative sentiment is actually a good thing for long-term investors. It's not a bad thing. It means that there's more opportunities. And then disciplined value approach. What matters is valuation, making sure that we don't have overpriced securities, quality risk, buying high quality companies, and then portfolio risk, making sure that we have good diversified portfolios for our clients. So that's a quick little update at the beginning of the year. Expect more ups and downs. Have a strong stomach. We've got our seatbelts on, and we are zeroing in on the opportunities for our clients. We'll be back to you with a lot more information on the year as it progresses. Also the RSP season, making TFSA investments and so forth, a lot of administrative things. Those will be coming fast and furious at you. But for now, I'll stop and leave it at that in terms of our first update for the year. Thank you very much for your support. We look forward to working with you in 2019. Goodbye now.